There you go. Okay. Okay, so one of the things we have in the securities industry, Zach, is called the Uniform Practice Code. You could imagine what a mess the securities industry would be if everybody does business differently.
Right.
We all agree to do business the same way, particularly as it relates to the back office.
Mhm.
And so, if you leave Fidelity someday, I don't think you need to build a career there, but and you went to Schwab, you'd be able to figure it out pretty quickly because we all do business the same way when it comes to back office support unit. And one of the things the Uniform Practice Code speaks to is the idea of settlement. Settlement is when ownership changes hands.
Mhm.
So trade date is when we agree to terms.
Right.
So, for example, if I do a securities transaction on Monday, July 29th, tomorrow, that would be called the trade date. And that's when we agree to terms. Kind of like real estate. We agree to terms. That doesn't mean I own the real estate.
Right.
That means we agreed to terms and we entered an escrow period. Typically 30 days later is when ownership would change hands.
Mhm.
And during that escrow period, I wouldn't be able to come to you, the seller, and say, hey, real estate has dropped and I want to renegotiate the price. That would be a bad thing, trying to renegotiate after you've agreed to terms.
Right.
And we think, if we had 30 settlements in the securities industry, nobody would settle because, they'd want to renegotiate. Either I want to pay less or you want me to give you more. So in our business, regular way settlement is T+1.
Right.
And as I said, settlement is when ownership changes hands. And so here, settlement would be Tuesday, July 30th. Yeah, let's put that up here. And in bonds, test question, bonds pay semi-annually.
Right.
Right. And so it's
Yes.
either going to be a J&J bond or an F&A bond or M&S bond. Let's say it's an M&S bond. And in our business, what that would mean is this bond pays interest on March 1st of September 1st.
Right.
If I buy the bond from you on Monday, July 29th, you say, well, Dean, on September 1st, you're getting a check. And all that check belongs to you, Dean, because they were my bonds in March, right? They were
Right.
my bonds of March, April. They were my bonds in May. They were my bonds in June. And they were my bonds per part of July.
Right.
You say, Dean, the vast majority of that money belongs to me. I said, well, Zach, when I get a check on September 1st, I will send you your pro rata share of that money.
Right. Right.
You say, no. You say, Dean, this is not a transaction. This is a relationship. So why don't we right now figure out of that 180-day period, how much of that money belongs to me? And I said, well, I don't want to do that. You say, well, too bad. The Uniform Practice Code says, test question, that buyers will pay sellers the dollar amount of accrued interest. No, so if I'm a Fidelity customer and I get my confirmation and I say, hey, Zach, I thought I agreed to pay 110 for the bonds. And you say, well, Dean, you did. I said, so that's 1,100. I say it is. And you say, well, Fidelity's telling me I owe $1,218.34. I said, whoa. That other amount is what you, the buyer, owe the seller for the accrued interest.
Mhm.
It is added to the price the buyer is going to pay and added to the price the seller is going to receive. Now, your brain wants to think if somebody's adding, somebody's subtracting, and that's not the case. We're going to do this once. It's added to the price the buyer is going to pay, seller receives. Now, when we came up with the Uniform Practice Code, We didn't want our high talent men and women to have to remember nursery rhymes and knuckle humps about how many days have September.
Right.
So in the Uniform Practice Code, all corporates and munis have 30-day months. That way we don't have to worry about nursery rhymes and knuckle humps about how many days have September. And that means we have 360-day years.
Right.
And that is too very testable to know that under Uniform Practice Code, we're going to be using for calculating accrued interest for corporates and munis, 30-day months, 360-day years.
Right.
All right. The three styles of questions you get are recognition. And so far, I've given you a lot of potential recognition questions.
Right.
Which of the following standardizes practices within the securities industry? A, code of conduct, and code of arbitration, and uniform practice code, ding, 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 ding.
Right.
Regular wage settlement is which of the following? T+1, ding, 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 ding. The settlement between broker dealers on the uniform practice code is T+1. But remember, just as an aside, not where we're at right now, Reg T customers get 2 additional days. Now, we're never going to tell a Fidelity customer they get 2 additional days because we don't want to use Fidelity money to settle their trade. But, we can't actually bother this customer until T+1 + 2.
Right.
Now, one of the common mistakes people make is this first month that we're calculating will either be a 30 or a 16. Because when I got paid on March 1st, when UZAC got paid on March 1st, that was for up to, but not including March 1st. And so that's going to be 30. Now, if this was an M&S 15, it's not. But if it was, when we got paid on the 15th, that would have been for up to, but not including the 15th. So
Okay.
the only day that can go into that first month is either a 30 or a 16.
Right.
Now, once we get that first month, we can rock and roll. You owe me for all of April. You owe me for all of May. You owe me for all of June. Now we got to slow down. I don't owe you for Tuesday because Tuesday, they're now my bonds. The buyer, I'm entitled to the interest from Tuesday, July 1st, going up to, but not including, right? The
Right.
reason we don't include settlement is because they're my bonds. I owe you up to, but not including. That too is testable. Recognize it's up to, but not including settlement.
Right. Right.
And now I may got to do the arithmetic here. And so that looks like we've got a total. Well, I'll get a different line here. We've got a total of 30, 60, 90, 120, 149 days of accrued interest. Now, I can't imagine they would ask you to actually do a dollar amount, but if this was like an 8% bond, that would be $40 divided by 180 would tell me interest per day and what you actually owe me. Now, another way you could do this, I'm about to show you a shortcut. And if you want to use my shortcut, what we're going to do is we're going to take settlement, which in this case is 730. This is just a shortcut. And we're going to subtract the last time the bonds paid interest, which was 3/1. And this part I can't help you with. This is just a shortcut. We're calculating accrued interest. Let's put that in a different color. And so you want to use my shortcut, you would simply take settlement, July 30th, 7th month of the calendar, 30th, and subtract the last time the bonds paid interest. And please note, we end up with the same answer. 1 from 30 is 29. And 3 from 7 is 4. And then you just got to remember that every month has what?
30 days.
Right. So you can either do it the long method, which is you literally count from the last interest payment date up to, but not including settlement, or you can use my shortcut.
Right.
Now, an accrued interest, a test question, there are some bonds that trade flat. And what that means on the test is bonds that do not include a calculation of accrued interest paid by the buyer to the seller. And that would be zero coupon bonds trade flat. Income or adjustment bonds trade flat. and bonds in default trade flat. Now, whenever there's three of a thing on the test, you should be standby for the accept format. They just love the accept format. All volume trade flat, accept.
Right.
And one more point. Govies are goofy. U.S. government securities are goofy. Govies are goofy. And one way in which they're goofy is they actually use an actual calendar. Right. So in the Uniform Practice Code, this would be an actual calendar and it would be 365.
But it's the same start from the trade date up until, but not including settlement.
That's right. Up to, but not including settlement. I think I'd be very unlikely because, the reason they don't like to ask anything other than recognition, because then I'd have to tell you whether it's a leap year or not a leap year, they just don't want to get into that with you. So that is accrued interest. Let me tell you what, on debrief, for a long, long time, this is typical. I would say to people, I haven't had anybody in a long, long time that's told me they had to calculate accrued interest.
Right.
These almost always are getting recognition. But over the last couple of months, I've had people tell me it's popped up again. So
okay.
I don't know. The draw you get, I'm wishing for you, Zach, a dream draw, everything you study shows up. But there's what I call face of death draws, you're like, oh my God. So that can be challenging, right? You got people like, I got it was the easiest thing I ever did. Oh, I have a faith that hardest thing I ever did. You go, which test is it? Right. So it's got a lot of stuff on it. Any other questions here about accrued interest?
Yeah. So just quickly saying we get that face of death draw, and you do have to calculate accrued interest. You would just take whatever that coupon rate is, whatever that yield is.
Okay. Let's just, I can't imagine we could do the dollar amount, but let's just say this is 10M, 8% bond. So M means 10 bonds, $10,000, 8%. Now this is testable. You need to know that 8% is based on par. That's $80, right?
Right.
So if I have 10,000 bonds or 10 bonds paying me 80, that means my annual interest is $800. Right. And so that's going to be paid to me in 2 semi-annual installments. So that is $480 that I receive every 6 months divided by, and what this is going to give me is interest per day.
Okay.
Right. Because I got to pay you whatever I owe you. I owe you $149 at, let's see what the rate is going to be. 400 divided by 180. And so an interest per day, that's $2.22 in interest per day.
Okay.
And then what I'm going to do is multiply that by how many days. Let me put it down here so we got some more room. Let me put it in a different color. Let's make it bigger. Right. So we got $400 for the 180-day period. And then we're going to times that by 149 days.
Right.
And let's say that, again, this would be added to that. So $2.22 times 149. By the way, Fidelity is, got computers that do this.
Right.
So of that $400, you owe me I owe you $330.78 above and beyond whatever that price is we've agreed for the bond. So that's how much of that $400 belongs to the seller. Right. Because remember, on September 1st, you're getting a check for $400. And what we're saying is that of this $400 that the buyer is going to receive on September 1st, this is how much of that is due to the seller.
Right.
And then again, I haven't had anybody in a long, decades tell me they actually had to do the dollar amount. But let's just say if this was a bond and we said that you could get it for 110, right? That's $11,000. Right. So it'd be 11,000 plus 330. So the Fidelity customer is expecting a firm that says they owe Fidelity $11,000 for buying these bonds.
Right.
But then what they're going to get is a firm that is going to be $11,330.78.
Mhm.
Right, that's going to be the total amount.
And so the buyer is not responsible for paying taxes on that. The seller who's
Yeah.
receiving.
I doubt I've never had anybody tell me they got the tax consequences. Yeah, but that's 330 that is the taxable to the seller, not the buyer.
Mhm. Right, right,
Like I'm gonna say, well, wait, I didn't get the whole 400.
right,
I get that the 400. I guess that's the other way to think about it, right? Of the 400,
right,
the amount of that belongs to. But by the way, remember, I'm keeping the whole 400 because I've already cashed you out.
right, right,
Remember, we didn't do this. What would happen is I'd say, well, when I get the check on September 1st, I'll give you that $330. You go, no, 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 no. You say, Dean, give it to me now. That way you can, we can get on with our lives.
right,
This is a transaction, not a relationship. I don't have some relationship with you that lasts
right,
till September.
right,
Just give me the $330. Then you get the 400, you keep it.
right. Go off in there both ways. Yeah.
Yeah.
Awesome.
All right. So anything else on this?
No, I think that covered everything.
Now, options is a big, big category. So
Yes.
is there a particular thing in options you want to discuss, or you just want to go from like ground zero all the way up, or
So I think definitely covered calls is a section in terms of like looking at what the break even of them
okay.
is.
Okay. So a couple ways to do cover calls. You can get
And
four
then
or five of them.
more of just like the advanced strategies,
Okay,
kind of
cool. We
differentiating
can do both.
between
So let's start with a
spread.
covered call. Let's do a covered call. You are going to get questions on a covered call.
Mhm.
How do you like to proceed best? You want to do a whiteboard? You want me to grab some slides? Well, fits your learning style better. We can do either, whatever makes you comfortable.
I think whiteboard would work.
Okay. So first thing we're going to do is we're going to buy some stock. So we're going to buy 100 shares of Apple. And let's just see what that's going to cost us. Man, Apple test question has a high beta. It moves.
Yeah.
So we're gonna buy this at $217 a share. Okay, so first thing, let me get this right. The first thing we should recognize when it comes to options, it's kind of a binary thing. And what I mean by that is at Fidelity, we have two players in options. We have people who have a stock position and are adding options to their stock position. And then we have speculators. So if I'm a registered option principal, I'm saying, okay, what does this Fidelity customer want to do? Do they want to speculate or they want to hedge? And you say, well, Dean, the customer has a stock position, and that's a hedge position. And that's much different. So, the first thing we got to do is know that stock positions dominate. Stock position dominates. So this is important to know that this is a bullish transaction, regardless what option need adds to this. I'm about to add an option position here in a minute. It doesn't matter what I do. When I add an option position, the stock dominates. You can't let the option tail wag a stock dog.
Mhm.
We should also know that we're either going to be doing a short call here or we're going to be doing a long put because we're interested in what's called the offset. If I've already bought the stock, which we've done here, I would be interested in selling the stock.
Mhm.
So I'm either interested in income or protection.
Right.
I'm either trying to bring money in or do that. Now, there's a lot of ways to do options. I practice the T. If you get pretty good at the T, you can do what I call the initial setup and you can track money. And you get good at contract specifications. You're going to 100 shares of Apple at 217. That's money out. Now you can use a minus sign You could use a plus sign, you could or minus sign, you could use debit. I
Mhm.
personally like to use dollars out. Now, as I mentioned, the good thing about dollars out versus debit or minuses, it kind of helps me a little bit. I should
Right.
also know that that means I'm interested, as I said, in the offset.
Right.
What it means I'm interested in being able to sell the stock. Right. So that's kind of helpful there, know that that's the offset, which would be dollars in. I say, hey, Zach, how would you like to agree to sell high stock you just bought low? Somebody will pay you hundreds of dollars in advance to agree to sell Apple at 225 that you bought at 217.
Mm. Right.
How would you like to agree to sell high stock you just bought low?
Right.
By agreeing to sell the stock at 225, we'll be able to bring in some money
Right. Right.
and lower your out-of-pocket costs. So what I'm recommending is that we do a buy right. A buy right. We're going to buy the stock and we're going to write the option. We're going to do a covered call.
Mhm.
Covered call because we're actually agreeing to sell stock that we own.
Right.
That's an entirely different proposition to agree to sell stock that we own.
Right.
Right. So be careful. You don't be looking for tricks on the test, but I can't write two contracts. I mean, there's no such thing as being partially naked.
Right.
I mean, you're either naked or you're not, right? So we can't write two here. We can write one.
Mhm.
Now I'm going to write one Apple. Now I need to decide how long am I willing to deliver the app. Longer term option contracts always have greater premiums.
Right.
So if I'll agree up to a longer term, I'll get more money. So let's see. This is what is this? July. Maybe we go out till October.
Mhm.
This is really important. We got to decide where we want to cap our gain. We do not participate past the strike price. Our gain is capped.
Right.
If we don't do this, if we just buy 100 shares of Apple at 217, we have unlimited reward potential.
Mhm.
But now we're about to put in a ceiling. I think of options as being about floors and ceilings. So a lower strike would give me a greater premium. Lower strike call contracts always have greater premiums. So we're going to write the October 225 call. And let's say that we get 9 for that. And again, I'm a big believer in the setup. I like to spend a lot of time trying to get comfortable with what I'm looking at. There's two things that as a tutor, I want people to be able to do. I want them to know contract specifications, that this is an obligation to sell the stock you own at the strike price.
Mhm.
And the other thing I want you to know is how to track money in and out. And so this is going to be 9 points in. And we're going to put that over here. Now, by the way, you could, if you chose to, put $21,700, $900. I wouldn't suggest doing that for a couple of reasons. And it's very easy to get zeros transposed.
Mhm.
And, we don't express break even as a total dollar amount. We express it as a per share number.
Right.
Now, where most people get hung up, and I don't know if I should share with you negative energy, but, where most people get hung up is they think that's an option position.
Mhm.
They say, oh, yeah, Dean, call up 234. Max gain is my premium, $900.
Right.
And I'm a bear and I have unlimited loss potential.
Right.
So that I told you got to be really focused on these stock plus options.
Right.
That you stay focused on the stock.
Follow the stock. Right.
This is a stock position, right?
Mhm.
So break even is always the first kind of pivot we want to be able to have in terms of moving forward. Now, one thing I like about the T2 is if you get good at the T, you don't have to memorize a lot of break evens because it becomes a little more transparent. Because break even is same dollars out as dollars in.
Right.
And so this is the one time and the one time only. It is not call up. It's going to be the stock cost less the premium equals the break even. Now, if however you want to go, memorize it, or or just get your T, but that's very much a test question
Right.
to know the break evens, right? And break evens kind of that first thing I want to do. I would put this on my scratch paper first. And what I mean by that is on my scratch paper, I'd make my T. And then, by the way, if you get good at this, remember now you can actually shop the answer set and just whatever you put in that box that would make it balance, right? They're going to offer you 4 choices. And if you have this, let's get your T going. I'm not being facetious. I'm terrible at arithmetic. So I'm going to use my calculator. Somebody offers me a calculator. I'm going to say, thank you very much. 217 minus 9 is 28. Now I can prove that, assuming I got my T. Right. Boom. Same dollars out as dollars in. By the way, we did get some price decline protection. We didn't do this for price decline protection. But indeed, we lowered our out-of-pocket costs from Apple from 217 to 208.
Right.
So that's kind of bueno.
Right.
I mean, if I was a Fidelity customer and I did this in my margin account, I would have to come up with half of 21.7, right? So that would be 21,700 times 50%. But I already have some of that money in my account. I need 10,850, and I already got 900 in the account. So I don't have to come up with 9,950.
Right.
Pretty cool, right?
Absolutely.
So yeah, lots of bueno there, right? So bueno on the break even. One time only that we have a break even and it's call and we're subtracting. Now, another thing you could do is you could say, well, okay, well, I'm out 217 for the Apple. I brought in 9 points for that option contract. And so that means I'm net out of pocket. Net out of pocket 208. That's the other way to do it. So I don't know what method you've been using to do break even, but lots of ways to think about it.
Absolutely.
Almost all of them are a variation of tracking money of some sort.
Right. I like the dollars. I've been doing debit credit, but like you said, I kind of like the dollars out, dollars in. Just
Yeah,
you don't have to remember
whatever floats your boat.
Yep.
I had somebody said, Dean, I have my own method, and I said, well, you're not getting right answers, so
right.
So you got to do okay. So break even. Boom, that was our break even. And as I said, I'm a big believer in the setup. The downside, to this strategy, and boy, the test is always so negative. I mean, there's no good news on the test. It's always bad news. And the bad news on the strategy, we have a ceiling.
Right.
We don't participate past that strike price. Right. So our max gain is when the stock gets called away from us at 225. So the ideal closing price would be 225 because then we get to keep the stock and do it again. But the max gain. So there's a couple ways again to do the max gain. One way to do it is simply memorize. And if you memorize, right, that's going to be the break even. As you recall, we were net out of pocket for the stock, 208. And boom, let's put that there. And we have to deliver the stock at the strike price. So it's the break even to the strike price. XP means strike price. And options notation. And the break even in here is going to be 225. So the difference in there is 17 points.
Right.
Or you can just net the T. A lot of ways to do it. You can net the T, and that's what that looks like. In the best case scenario, 217, 234. So, however you want to get there, that's how you get there. Now, another way to think about this break even to the strike price is you don't participate past the strike, right? So equivalently here, you're getting, 234 for the stock equivalent. In fact, there's 3 sources of profits here, right? So again, covered calls are the most conservative strategy. One source of profit is the difference between 217 and 225. 8 points there plus the 9 points. That's a second source of profit.
Mhm.
And the third source of profit is any dividends along the way belong to you,
Right.
right? So there are a lot of ways to make some money.
Right.
I doubt you're going to get too in the weeds on taxes, but covered calls are a little funky in terms of taxes. This would be my cost basis in this example. So for the most part, except for like covered calls, for the most part, taxes follow break even.
Mhm.
But the exception to that is in a covered call, and this is called my sales proceeds. So it doesn't follow break even. Now, most of the option strategies follow break even.
Right.
Right. So if I tell you your client buys 100 shares of Apple at 217, writes an Apple October 225 call at 9, gets exercised. What is the cost basis? You would say 217.
Mhm.
What are the sales proceeds? You'd say 234.
Right.
Right.
Okay.
Okay. One more other thing. I gave you the two most important things. Why do we do covered calls? Very test question on suitability. We do it to generate additional income. So we'll see on the test. Your customer is interested in generating additional income on the stocks in his portfolio or supplementing his dividend income. What should we recommend? We would say a covered call.
Right.
So that's a suitability question. We said we need to be able to do break even. We need to do max gain. And max gain is testable because what we're testing you on the max gain in a covered call is this idea that you do not participate past the strike. So the more bullish we are, the higher the strike we ought to write. The less bullish we are, the lower the strike we're going to write.
Mhm.
So if we're neutral, there's no such thing as an Apple 217 call, but if we're neutral, right at the money, and if we're bearish, we'll right in the money,
Mhm.
and if we're bullish, we'll right out of the money.
Right.
Okay, now what I didn't show you, the last thing here is the loss. And yeah, you're a loser, but if the stock goes to zero, you get to keep the 9 points.
Mhm.
Now, again, you're not going to be happy with this as a customer.
Right.
I would say, Zach, you didn't fall down 217 flights of stairs. You only fell down 208 flights of stairs.
Right. Right.
Your max loss is the break even to zero. So you don't do a covered call because of the hedge.
Mhm.
You get a partial hedge, kind of works. You get that 9 points, but once you go past 208, you're starting to lose money, right?
Right.
So the max loss here is break even to zero. All right, so there's a working model of a covered call. I think you would see 3, 4, 5 of these. You're looking for 20 options questions on the test,
Right.
and very easily, I always tell people there's 9 option strategies, and the big ones on the test are the basics: long call, long put, short put, and a covered call. Those 5 of the 9 strategies are where most of the questions lie
Okay.
on Series 7.
Right.
Okay, so any questions on this covered call and what you could expect to see?
Yeah, so kind of just spinning off of that a little bit. So like if you were to long a put on a cover, like if you had an underlying stock position and you longed a put,
Yeah,
that
so
would be
that would
protection.
be a different position. So again, let's just we can show you that too. So that would be protection,
Mhm.
and we would be marrying a put to our stock position. So
Right.
same thing again here. Let me get a different color. What I mean by same thing is you got to stay focused on the stock.
Right.
The stock always dominates, right? Always dominates. And now you say, hey, Dean, I want to have the ability to participate in a big price increase, but not participate in a big price decline.
Right. Right.
We said options are about floors and ceilings. Now you're saying, I think I want to put in a floor.
Mhm.
I want to buy some insurance on my stock position. Insurance is for protection. You don't buy insurance because you plan on wrecking,
Right.
right? You buy insurance just in case, right?
Right.
Uh-oh, I'm building this off-grid, I don't compound at this point.
Right.
I got contractors running all over the place, and I got 2 contractors, Zach, and one of them brought a dog the other day, and he put together a contractor, and I'm looking up one of the guys is on the roof, and I haven't added this off-grid location to my insurance policy. So right now, Zach, I'm naked.
Right. Right.
And I'm thinking, oh my God, if anything happens here, it's going to be a major problem. And
Right.
I told the guy with the dog, I go, listen, you can't bring the dog back on the property. I mean, I love dogs, but it's, my brother's dog can't run around while your dog's here. And,
Right.
so, don't come to work if you got the dog.
Right.
Anyways, I'm thinking I got to call my insurance agent and say, hey, listen, add a rider for this thing. It's becoming it's a risk now that needs to be insured is the point.
Right.
And
right.
if you may not want to insure it, or you may decide. So now we're going to insure this thing. We're going to go buy. Now, again, it's important that we recognize that if we have 100 shares, the hedge we need is going to be one contract. If I had 1,000 shares, we want to have 10 contracts.
Right.
So we're going to buy one Apple. Now we got to decide how long we want the protection in place.
Mhm.
The longer we want the protection in place, the more it's going to cost us.
Right. Right.
Right. So I don't know, maybe we go out till October. Now we got to decide, where do we want the floor? A choice to sell at a higher price will give me greater protection.
Mhm.
But will cost me more money.
Right. Right.
A mantra that's very important: lower, higher, longer.
Right.
Lower, higher, longer. Lower strike call contracts always have greater premiums.
Mhm.
Higher strike put contracts always have greater premiums. Longer term option contracts always have greater premiums.
Right.
So now we got to decide at what price we want to sell. Maybe we want to go for a 215.
Mhm.
October 215 put. And let's say that's going to cost us 8 points.
Mhm.
Now, I am a big, big believer in what I call the initial setup. And so what I mean by that is I want as a tutor, my students to know what are contract specifications. This is a choice to sell the stock we own at the strike price.
Right.
And remember, we know it's going to be one of the two, short, call, and put, because we're interested in the offset. Right. That's whenever we bought it, boom, there's our offset. If we bought the stock, we're interested in being able to sell the stock.
Mhm.
So that's one thing I want us to know. The other thing we said we got to be careful on, and I told you this is the common mistake. Either people get to speculative and not the hedges, or they get to speculative and not the hedges, or hedges and not speculation. What I mean by that is you got to stay focused on the stock.
Right.
Right. People go, oh, I know puts, Dean. Long put, my break even is 215 minus 8. I'm a bear. So that's 207 is my break even. 215 or higher, I lose my premium. The most I can make when go break even to 0. When you have stock and options, the stock dominates. So now I paid 8 points for the protection. This is the one time and the one time only. We spent all that time on call up, put down. This is the one time we have a put, and we are not subtracting it to break even.
Mhm.
This is the one time and the one time only that it's going to be strike price, or excuse me, stock cost plus premium. And the reason that's the case is because this is not an option position. This is a stock position.
Mhm.
And so our break even here is what we paid for the stock, 217, plus what we paid for the protection, 8 points.
Right.
And so our break even is 225.
Right. So
And
anything.
the break even is always the first thing we want to be able to do, because that's the pivot.
Right.
Right. That's what helps us decide what we want to have happen from that. And we said the stock is always the dominant position.
Mhm.
The stock is always the dominant position. So whenever you have stock and options, you got to stay focused on the stock.
Right.
And again, some people like to use minus. I'm out 217 for the stock. I'm out 8 points for the protection. So I'm net out of pocket 225.
Mhm.
Right. So that's the first thing. Now we do this, as I said, as a hedge. they have the ability to participate in a big price increase, but not participate in a big price decline. By the way, if you get good at the T, I've warned you that, or given you a heads up, that what's great about the T is you can use it to just go now through the answer set and say, okay, what number did they offer me on my exam that will make the column balance?
Right.
Right. If the choice B says 225, I plug it in. I go ahead, ding, 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 ding.
Right.
Right. So I always think of those answers as offers being made to me.
Mhm.
And then, do I want to accept the offer? And I say, okay, let me see if I want to accept that offer of $225 as being the break even.
Right.
Worst case now. Well, I don't know. I'm bullish. Remember, I want good news for Apple.
Right. You want to go up. Right.
I want good news, but maybe they say that I don't know, the AI that they joint venturing with Chat GPT is taking over everybody's Apple phone and spending tens of millions of dollars on porn. I don't know.
Right.
And Apple has to shut down all the devices and the stock, tanks.
Right.
And I say, well, at least we can sell it at the strike price. The worst case is we're going to exercise our put.
Right.
And the most we can lose is the break even to the strike, because that's where our protection kicks in.
Mm-hmm.
So that is our worst case scenario. So as I said, we have the ability to participate in a big price increase because there is no ceiling here.
Right. It's unlimited.
There is no ceiling. All that's here is a floor.
Mm-hmm.
And, it's like, you say, well, gee, Steen, if the stock is above that, did we waste our money on the protection? I go, I don't know. I guess so. I mean,
right.
If I don't file a claim, did I waste my money on insurance? I don't think so. But,
right.
I had a doctor client, I hold a grudge a long time, and we got really lucky. The stock roared, and I called him. It went from like 90 to 180, and I wanted to buy a 175 put. It was cheap because the stock was roaring. It was, Dean, you get a commission? I go, yes. I wasn't even thinking my commission. I said, doctor, if I was after commission, I'd put like a sell stop at 179.99.
Right.
Get you bumped out of the stock. I make more doing that than getting you to buy the protection. And he said, well, Dean, if the stock is 175 or higher, the put will expire. We've wasted our money for the protection. I go, well, that's true too.
Right.
I said, he didn't do it. And the stock came roaring back down. It was kind of fun, right? Because I got to call him every day and say, man, if you had that 175 put, every dollar you'd be losing in the stock, you'd be making it up on the intrinsic value of the put.
Exactly.
It would add a perfect, but the thing I'm maddest about it would have been perfect correlation as a hedge.
Right.
Very rarely do you get perfect correlation where once it goes below 215, you're no longer at risk because, you're losing money on the stock, but you're gaining on the put. Right. And remember, this is a bullish transaction. So you're going to get, we said you get a 50-50 right out of the gate by knowing that if you bought the stock, your interest in the offset. So it's either going to be this one for income or this one for protection.
Mm-hmm.
Hey, you might not want to pay for the protection.
Right.
And so, hey, if we want, Zach, we could sell the call, that 225 call at 9, buy the put for 8, and we would have a cashless caller. You wouldn't have to pay for the put, right? Because you brought in 9.
Right.
In fact, we're still up a point, right? Because, the cashless caller is when we sell the call to pay for the put and we got no money out of pocket.
Right. Right.
That would be in the scenarios they give you on the test, it would be 8 and 8. Mm-hmm. I sell the call for 8 and I buy the put for 8. And I got no out of pocket cost. But again, then I have a floor and a ceiling, right?
Right.
I don't participate on the upside past the call strike. And I don't participate on the downside past the put strike.
Right.
Hence the term caller.
Mm-hmm.
Okay. Any other questions on this one?
No, I think that was very helpful.
Okay. So now we have 2 advanced option strategies. So I think where a lot of people get hung up is they think there's a zillion things going on.
Right.
There's not. Right. There's 9 option strategies. The 2 advanced strategies we have are spreads and straddles. Mm-hmm. Now, of those 2, which one would you like to talk about first?
I think maybe we'll
I'm sorry, you broke up a little bit.
straddles
Okay,
first.
straddles. Okay, so here we go again. Apple's at 217. And if I thought Apple was going up, I'd buy a call.
Right.
And if I thought Apple was going down, I'd buy a put.
Mhm.
But the point is, I'm not quite sure. So what we're going to do is we're going to straddle the strike price line. So I'm going to buy one Apple October 215 call at 7 points. And I'm going to buy one Apple October 215 put at 7. Now, the first thing we have to be able to do on all of these strategies is identify.
Mhm.
Because if we can't identify the strategy, we're just going to be staring at the screen going, I don't know. So even if that wasn't a test question, I just told you it is. But even if it wasn't, if you can't identify it, it's going to be a problem.
Mhm.
Now, what we're straddling is the strike price line. And so here is the market price. Here is the market price of Apple. Woohoo! Right? Apple could be anywhere from 0 to infinity.
Mhm.
And we're looking here at a 215 call. And so that was what we're straddling. We're straddling this strike price line. There's our strike price. Boom. The second test question, after we've identified this as a straddle, is can we calculate the break evens? So first test question is, can you identify a straddle? The second test question is, can you calculate the break evens?
Mhm.
This is the only strategy in which we have two break evens.
Right.
All the other ones, we have only one break even, but here we could have two break evens. And the way we're going to do that is we're going to take strike price plus total premium, XP means strike price. And that's going to give us our upside break even. We're going to have two here. Now let's put it over here. So here our strike price is 215. We're total out of pocket. We're total out of pocket 14. And so our upside break even is 229. Now, again, you could confirm that. You could confirm that by making a T and saying, okay, here is my 215 call, and I'm out 7 for that. And I'm out 7 points. Oh, boom. That's what I'm total out of pocket. And so if I buy the stock at 215, which I have a choice to do, and I sell at 229, I'd make 14 points. I paid 14 points. I proved that the break even, the upside break even here is 229. Nobody does things to break even. People do things to make money.
Right.
Downside break even, call up, put down.
Mhm.
So it's going to be strike price minus total premium. And that's going to give us our downside break even. So on the exam, we've got two break evens. It's the only one where we have two break evens, strike price minus total premiums equals the downside break even. And so here it would be 215 minus 14. 201. And again, I'm just illustrating that indeed that is the case. Here's boom. Here's our downside break even. I have a choice to sell the Apple at 215. So if I buy the Apple at 201 and I stick it to somebody at 215, I'd make 14 points. I paid 14 points. I break even. Nobody does things to break even. People do things to make money.
Right.
Right. So that's our third test question. Our third test question is, where is the straddle profitable? Where is the straddle profitable? We have a good memory aid device for that. The memory aid device for where our straddle is profitable is silo. No, and that stands for short inside, long outside. If you're long a straddle, which we are here, you would want it to be outside of your two break evens. So what we want here is we want Apple to be above 229 or below 201.
Right. And that would be because this investor in this case would be seeking volatility. They think it's either going to rise or fall.
It's exactly right. Good, major point strategy wise. Not testable, but in all speculative strategies, you're either buying volatility or you're selling volatility. It's either your friend or it's your enemy. Right. So when I buy a call, buy an Apple October 215 call, I'm buying upward volatility. Very tough to be right, Zach, because when you buy an option, you got to be right about three things: direction, you're choosing up. You got to be right about how far up. You're saying at least 7 points. And you got to be right about timing. You're saying all this is going to take place between now and expiration.
Right.
When you buy a put, just a put, not a straddle, you're buying downward volatility. You're saying the stock is going down. You're saying it's going down by at least 7 points.
Right.
And you're saying it's going to take place between now and October. When you're long or short the stock, you only have to be right about one thing: direction.
Right.
And if I'm short, I'm saying, okay, I'll take that bet. I'm saying, listen, you may be right, Zach, that the stock is going to go up. You may be right about, that, but I doubt you're going to be right about all of those things. Right. I mean, and I just need you to screw up, basically. So I'll take your money. Right. So that's what we mean by that. So here you're buying non-directional volatility. You nailed it. You're buying non-directional volatility. You need the volatility because you got to cover your out-of-pocket cost. Right. So, I don't care if it goes up or down. I bought a straddle. They hired a new CEO. And I thought either he's going to fix their problems or he's not. Right. I mean, either he fixes the problem, the stock goes up. By the way, I didn't think he was going to fix the problem. So Zach, I bought the puts and they were like 2 points. And maybe I'm too much of a cynic. Maybe he will fix their problems. I go, what do I care if I lose $2,000 or $4,000? For everybody, that's a different number, Zach. But, for me, $4,000 is a lot of money. So, I bought the straddle. I thought, well, I'll just buy the call. Thank God, because the put expired, but my call came through. By the way, I legged into the straddle because first I was like, this guy isn't all that. He ain't gonna fix it. Right. I always joke, would it be funny if it was like our business? Because, so I sometimes when I'm in Vegas, that's my other location. And on a Friday night, I like to go, gamble and have adult beverages, and I like to play. And anyways, I'll be at the roulette table, and sometimes I feel like, man, these people, we should have a registered gambling principle here that asks these people, is this the kind of money that they can afford to lose? And maybe we should give them a gambling disclosure document about all the bad things that can happen to them. Not only do they not do that, they give us adult beverages to help us with our math and our judgment skills while we're right. So a little different. All right, our last question about a straddle is when do we use it? And you nailed that. That's that fourth question, right? We're either buying the volatility or we're selling the volatility, right? So it's, by the way, once it dawns on you that we have opposite expectations, it's half as much to learn. Right. So good news for one guy is bad news for the other guy. Options are a zero-sum game.
Right.
That's that means what's that knowledge? Any boom. But straddles are pretty good, right? I mean, what I mean by straddles being pretty good. Couple of test questions here. Once it goes outside of the break evens, this guy starts to lose money.
Right.
And a short straddle, because of that naked call, has unlimited risk. You're not going to get killed on the downside, but you just can really get killed, right? Because of that naked call. Right. So unlimited risk. So can you tell me it's a straddle? By the way, you wouldn't do anything different if it was a straddle with different strike prices.
Mhm.
Straddles with different strike prices are called combinations.
Okay.
Wouldn't do anything differently. Can you calculate the break evens? We said there's two.
Mhm.
And then can you determine where is the position profitable? Test question number 3. Got a nice memory aid, silo, short inside the two break evens, long outside the two break evens. And then where do you use it? Now, we talked about, you nailed when we buy a straddle. Where do we sell a straddle? Well, when we expect a trading range. Short straddles are really seductive. Do you think Apple's going to stay between 201 and 229 between now and October? If so, there's a way to profit.
Right.
Right. I mean, that's pretty seductive. And, call options are us.
Mhm.
That's a short straddle. That's a short straddle.
Right.
Okay. So, any questions on straddles?
Yeah, just quickly, so a combination is the same thing, just different strike price.
In other words, let me just change this. Remember, I'll be nastier than the test. What I mean by being nastier than the test is I will change the premiums. And so let me just get rid of this here. Boom. And so what would make this a combination is, come on, a different strike. And that means we'd be looking at different premium here.
Mhm.
And so we were looking at a 215 put. But what if Dean says now it's going to be a 220 put? Would that have a greater or lower premium than the 215?
That would have a greater.
Right up, right on. Remember the mantra, lower, higher, longer.
Mhm.
And so let's say now that's 9 points. Because if you think about it, that's already 3 points in the money, right? Apple's at 217.
Right.
But my point is you wouldn't do anything different.
Okay.
So now the break evens would be 9 plus 7, 215 plus 16, and 220 minus 16. So it'd be 204. And again, I'm not being facetious, I'm going to get my calculator, 215 plus 16. 215. Upside break even is now 231.
Mhm.
Right. So you wouldn't do anything different.
Right.
Silo, we'd want it short inside the two numbers we established, long as we want it outside. You buy a combo for the same reason, volatility. You sell a combo for the same reason. So combos are simply straddles with different strike prices. You don't do anything different in terms of your analysis.
Okay.
Right. And then that means the only other option strategy that you're held accountable for is a spread.
Mhm.
Right. I always call it don't hate the 8. There are 8 potential things that I could ask you about a straddle.
Mhm.
Or should be about a spread. Can you identify a spread? Can you determine credit or debit? We get that right, we can rock and roll. We'll do this in just a sec. Do we want the contract to expire or be exercised? Do we want the difference? The spread is the difference. So that's what spread always means. Like I say, what's the spread on the Serbian basketball USA game today? Don't tell me because I haven't watched it yet. It's being recorded. But they say, hey, Dean, the spread is 15.
Right.
And I go, okay, I think Team USA can beat them by 20 at least. I'll take that bet. And
Mhm.
just like a spread, some people want to be in the spread. Some people want outside that spread, that difference, right? You either want it to be more than 18 or less than 18, depending on the bet you've made.
Mhm.
That's the hardest concept to get. We don't really need to get it because it goes together all the time about this idea of narrow or widen. And boom. That should be an over. There we go. We've got to be able to do max gain, max loss. You know, there's not a lot of common threads that run through options, but one of the threads is if you spend money, that's your max loss,
Mhm.
right? You buy a call, you buy a put, you buy a straddle, you buy a spread, that's your max loss. And if you sell an option position, you're short a call, short a straddle, short a put, sell a spread, short a spread, that's going to be your max gain. Break even. And we got to determine whether spread is bullish or bearish. If you do these 8 things, you know, whatever they want to know, you've got the answer.
Right.
All right. So let's work on that first part of this. Let's work on identifying a spread. So Dean is going to sell or short one Apple October 220 call at 12. Um, you know, as we said, options are all about floors and ceilings. And this is really kind of foolish. And the reason this is kind of foolish is because I have a floor, but I don't have any ceiling.
Right.
I mean, you know, 220 or lower, the call's expired. I get to go neener. But, you know, if I'm wrong, I got some serious problems here.
Right.
Here is the market price again of Apple. Right. You can go anywhere from 0 to infinity, right?
Mhm.
There's a finite supply. Here is my 220 call. Right. And so this is just a basic position. Before I turn it into a spread, my break even's 232.
Mhm.
My max loss is unlimited.
Right.
My max gain is the premium,
Mhm.
and I'm a bear.
Right.
And so, as I said, this is just really, really foolish because it's like picking up nickels in front of bulldozers. And so I say, you know, Zach, what I think we should do is offset your obligation to sell with a choice to buy.
Mhm.
Let's buy. The conversation I'm having with you is not testable. But let's buy one Apple October 230 call at 4. And that's going to be money out. Now, as I told you, I am a big, big fan of what I call the initial setup. You know, so before I do anything, I like to say, okay, what am I looking at? And, you know, what I like to do is get good at my contract specifications. I'm looking at an obligation to sell at the strike price. And now, smart that I am, I have a floor, but I put in a ceiling. I'm doing some construction.
Mhm.
You know, construction costs money. And so now I'm offsetting my obligation to sell with a choice to buy the stock. Pretty cool. I'll tell you when it gets testable, but I've actually changed this position from unlimited risk to limited risk. That's pretty neat arrow to have in my quiver. You know how to change short, you know, unlimited loss potentials into, you know, something a little better, right? Okay, so I like to get my T fired up, or you can, you know, however you want to proceed. But you know, if you do enough practice tests, I hope I get so aggravated when people tell me that they had a time constraint on the test, and I go, well, how could you have a time constraint? Because, you know, you should have done some practice tests and kind of know how long it takes you to work your way through, performance opportunities. First test question we said we have to be able to do is identify a spread. A spread is when you're long and short the same type of contract. And what you're spreading is the difference in these premiums. What you're spreading, spread is the difference in these premiums. So this is 12 in, and that is 4 out. So boom. So now what we're doing is we're doing our next really important thing, because if we get this right, we can rock and roll. Right. So whether you want to do it there on your scratch paper, or, if you're going to do a T, which I'm a big fan of, I like to put my 12 here. When you got lots of things going on, you got to be a little more disciplined about process. So, I fall short. Do as I say, not as I do.
Right.
I don't think I'll ever get to use a real dry erase board, Zach, again. But, one of the things I always tried to do when I'm teaching with a whiteboard is every once in a while, I'll step to the back of the classroom, look at my whiteboard and say, okay, does it look like there's another thinking mind doing something?
Right.
If it looks like it's chicken scratch, well, okay, well, that's not, which Fidelity campus are you at?
Smithfield. So
Okay.
I'm Rhode Island. Yep.
Yeah. I used to spend a lot of time going around different Fidelity campuses. And
Yeah.
one time I was at the Salt Lake City one, and we were doing class, and I, as a joke, had picked up an order ticket and filled it out, and then they teased me and said, "Hey, Dean, we called that in for you." Like, what? Anyway, so we'll use a T, whatever you're doing here.
Yep.
Let's just label this. This is our 220 call, and let's label that. And let's label this. This is our 230 call. Okay, so now we can rock and roll, because our next question, remember, is to establish whether we're looking at a debit or a credit spread. And then we simply net the premiums to figure that out. Now, whether you want to use a plus sign or dollar sign, but this is actually 8 in. Right? So this is a credit spread. And the reason it's a credit spread is because we have more money coming in than we've got money going out. And once we get that credit of 8, we can really kind of rock and roll. Because once we get the credit of 8, we say, okay, well, in options, I don't know if it's helpful, Zach, I think of when I write an option contract, I'm a potential victim. And nobody's going to agree to be a potential victim unless you give them some money. Right? Now, I think you're a real jerk of a customer if you say, Dean, had we do on the 220s naked, we would have made 12 points instead of 8. I said, yeah, but we would have been taking all kinds of risk. Why pick up nickels in front of bulldozers? That ain't smart. Once we get that, we can rock and roll. Credit has 6 letters. Expire has 6 letters. Narrow has 6 letters. There is no circumstance which on the test, you tell me this is a credit spread and you tell me expire and narrow, you don't get it right. Now, narrow is referring to the difference in the premiums. So when we establish this position, the spread, the difference was 8.
Right.
And so you call me up, you say, hey, Dean, what's the spread today? I say the spread has narrowed to 6. Would you like me to close it out for a net gain of 2? What's the spread today? I said, well, Apple's been going down. Options are a wasting asset. As we get closer to expiration, these things are going to be worth less. The spread now is 3. You want me to close it out for a net of 5, the gain?
Right.
That's the hardest part to get. Don't need to get it because you'll be right all the time. The most it can narrow to is 0, right? At 220 or less, let's just put this here. All the action takes place between the strikes.
Right.
All the action is taking place between these strikes. And so, there's 4 in the ceiling. Right. So, most it can narrow to is when the apple is below here. That's our floor, because then they both expire. And then we keep the money, right?
Right. Right.
You know, we've been talking about this. Ops are all about floors and ceilings, right? So this is our floor. And this is our ceiling. All right. So the next thing we got to do is our max gain. As we said, we should know that when we collect money, the best case is we keep it.
Right.
8 points or $800. You know, 220 or less, if these contracts expire, we would be a happy customer.
Right.
Because we get to keep the money. So our max gain in a credit spread is the net credit.
Mhm.
Now, there's a lot of ways to go, but I think the thing to keep in mind is that whatever the gain and the loss is, it has to equal 10.
Right.
The whole point of a spread is I'm saying I want to play between 230 and 210, and then I don't want to play no more.
Mhm.
So if you don't get that, if you don't get that, then you're going to have to memorize
Mhm.
that the maximum loss in a credit spread is the difference in the strikes, 10,
Right.
less the net credit of 8, which is 2. I just think it's easier. 8 plus something, I think is easier, equals 10. You know, and that's 2 points.
Mhm.
Now, after you get the menu done, then you can think about it. I mean, what I say is don't think about it till you get the menu done. But if this thing blows up on me, I'm going to be buying the stock at 230. Thank God I can do that.
Right.
I'm going to be delivering it at 210, which I'm obliged to do. I'm going to lose 10 points, but 8's already in my fidelity again.
Right.
Or I only lose 2. So, you know, you can kind of play it out, you know, with a T in terms of figuring out that that indeed is the case.
Mhm.
So the max loss is, and I'll put that in there, is the difference in the strikes less the net credit. Difference in the strikes. That's net credit. Let's put that in a different color. Boom. And by the way, we said that whatever those two numbers are, they have to equal the difference. So the difference is 10, right? Right. And this is 8. And that's 2.
Mhm.
You know, if you're a visual person, over here, we have our 8. Let me just put that over here. There's our 8. There's our gain. And boom, let's put this in here. The gain and the loss always equals the difference in the strikes.
Mhm.
We only want to play between 220, 230, then we don't want to play them.
Right. Right.
Trick question, I mean, or a test taking trick. So we got a couple test taking tricks here. We know that the gain and loss always equals the difference in the strikes. The other thing we know is the break even has to be somewhere between 220 and 230.
Mhm.
So, you know, we can eliminate in the answer set anything that's offered to us that's outside that range.
Right.
That alone can get us a 50-50.
Mhm.
We know the break even has got to be somewhere between these two numbers. Right. Now, to do the break even, we've got two memory aid devices. We have cal and we have push. Cal and push. Cal stands for call, add to the lower. Call, add to the lower. Push stands for put, subtract from the higher. Right? So we're going to take the lower strike, which in this case is 220. We're going to add the net premium of 8. And we find out our break even is 228. Right? Now, by the way, you can prove that again with your T. Right? So I'm just going to illustrate that indeed that's the break even. Again, I recommend as your tutor that you don't start thinking about things until you get the menu done.
Right.
Once you get the menu done, then, knock yourself out.
Mhm.
The dominant leg in this spread is my obligation to sell Apple at 220.
Right.
And so ultimately, the break even is a number that would make the columns balance. And so if I buy the Apple at 228 and I deliver at 220, I'm going to lose 8 points, but I already got 8 points in my account.
Mhm.
I'm just illustrating that indeed we break even.
Right.
Right. So the other way you could do is say, okay, well, my dominant leg is the 220 call.
Mhm.
And so, that's where I could plug that into my T. Now, if it was a put spread, we do put subtract from the higher. The
Mhm.
last question we got to do, I said, don't hate the 8. Is we have to be able to determine whether it's a bullish or bearish spread. Where do we want it in relationship to our break even? We've established our break even of 228, and we said that the 228 is indeed within that range. It has to be in that range. And now we need to know where we want it to be in relationship to that. The larger premium dominates the position.
Mhm.
The larger premium dominates the position. This is a bearish spread. We want Apple to be below 228.
Right.
Anywhere below that, I'm a winner.
Mhm.
So this is a bearish spread. By the way, we should also be able to do that even if it's missing the premiums. We should be able to say that this is a credit call spread. I think that's the hardest thing to do, is to do this when you don't have the premiums.
Right.
So I already know that the lower strike call is always going to be the dominant leg,
Right.
because lower strike calls always have greater premiums.
Mhm.
So I could still do that, or should be able to do that, even if I didn't have any premiums there.
Right. Right.
All
So
right, so let's try to illustrate or demonstrate your prowess or a lack thereof on option strategies. So let me grab us some practice questions. And boom. Okay. Wait, did I ask you when your test date is? Did you tell me when your test date is?
I take it August 15th.
I always got lots of time. Have you done any practice tests yet?
Not yet, no.
Okay, when are you planning on doing that?
I'm planning my first test to do like this upcoming Saturday.
I like it. I like it. So check in with me and let me know what that score is.
Absolutely.
And this is not a transaction, it's a relationship.
Right.
And you're at Fidelity, and I'm a big fan of the Johnson family and Fidelity. So, can't have any Fidelity people going down. That would be bad. Can you see my screen?
I cannot.
Okay, let me try it again. Come on, Dean. Let's try it again. Whoop. Boom, boom, boom. There
You
we
said you're
go.
located out in Arizona?
Yeah,
Or
I'm in Las Vegas,
okay.
but I'm at my off-grid cabin in northern Arizona. So now I'm in my off-grid location. I'm thinking about at some point transitioning to this off-grid location, but I'm not quite yet ready to give up civilization.
Right.
So it started as an adventure with my brother.
Yeah.
He was the first one to come off grid, and then I came out, and I told you I built a cabin. I built this, I built a solar system, so I've got building almost a small city out here. So at some point, to justify this, I would have to kind of, I think, at some point move out here. But
Right.
my contractors are funny because I'm the city slicker guy, and
Yep.
most of the people that are out this way are getting ready for the zombie apocalypse.
Yep. Yep.
And I was telling them, I said, when I build a solar system, I said, listen, you guys, I know how you do it. I'm going to buy lithium ion batteries. I want to pick out my own solar. I just want you guys to look that up because I don't want to ever have to have an energy budget. I
Yep.
want to be able to power this place. So I'm going to build an 8-lane freeway for two cars because I don't ever want to have that problem. It was funny. They're all lead iron guys. But at the end of the day, I feel like evangelicals. Now everybody's big fans of lithium ion.
Yep.
And I'm having them build me a deck, and I said, I don't want to use real lumber. I want to use synthetic lumber. And so, they're starting to go, well, maybe the city slicker isn't as stupid as we think he is. So yeah, I got a lithium battery that will, I always joke, could probably fly the Millennium Falcon. Thing is so big. Hold on, let me just, I don't know why I can't find my slides here. Oh, I know what I did. There we go. Okay, try it again. Can you see that?
I can.
Okay, so here we go. We don't want to do variable annuities. We want to do options. And there's some options. And as your tutor, what I asked about your test data, I think you're pretty good, but we'll find out. We're going to have you demonstrate your prowess or lack thereof. Can you see the screen?
I can, yes.
Okay, your customer buys 10 ABC July 25 calls at 4.5. What is the total premium paid for the position?
Gonna be that 4,500.
Excellent. Excellent. What's your break even?
It is at 29.50 per.
Right on. And are you bullish or bearish?
You're buying the call, so you're bullish.
What's your max loss?
It is the premium, so that 450.
Yep. What's your max gain?
Unlimited.
Excellent. 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 An investor buys an ABC May 45 call at 4.25 when the stock is trading at 43. The put contract has intrinsic value when the stock is.
It is below 40.75.
We got you. Be careful what you're being asked. We didn't ask you about break even. We asked you about intrinsic value. We're not asking about the investor here. We're asking about the relationship of the strike price, 45, to the market price. Anywhere below 45, that contract has intrinsic value.
Okay.
Different question. What's your break even? You would have been correct. 45 minus 4.25. That's a different question, right? And of the premium, 2 points represent intrinsic value, 2.25. Now, these are questions, the bonus questions are questions that were not asked.
Right.
Right. The break even is strike price minus premium. Max gain is break even to 0. Max loss is your premium and your bear. P.S. You're a smart bear. Because if you're wrong, you just lose your premium.
Right.
I always joke, don't be a dumb bear. Gonna be a smart bear, right? Be a smart bear. All right, let's try another one. This is today's discussion. If your customer owns 100 shares of stock and wants to participate in a big price increase, but not participate in a big price decline, you may recommend.
It'd be the writing the calls and the selling the puts.
You would buy a put to protect against the big price decline. Because if you buy the put, you get the protection. You put in that floor.
Okay.
All right, let's try another. An investor with no other position buys one CDE, May 65 put at 3.5. If the investor buys the stock at 63.5 and exercises the put, what is the investor's profit or loss?
So when you say no other like this is his only position?
Yeah, they're telling you that this is it, right? So you bought an ABC 65 put at 3.5. You buy the stock at 63.5 and you exercise your put. I personally think this should be a churning question because there's 3 trades going on. Only on the test there are no commissions. Now, the real world, it's going to be a problem, right? So, and then they're saying, what is the profit or loss? So we paid 3.5 for the put.
Right.
We paid 63.5 for the stock. So we're out 67. We exercised the put. That means we had a choice to sell. And so we lost $200.
Okay.
Now, the other way you could have done that is you could have just got your break even of 61.5
Mhm.
and said this is 2 points in the wrong direction.
Okay, right.
You've done it either way. Today's discussion. A customer who owns 100 shares of stock and wishes to generate additional income on that stock. Which option strategy would you recommend?
Sell a covered call.
Right on, very testable. Right, generating additional income. Here we have 3 dumb bears and 1 smart bear. We said don't be a dumb bear.
Right.
Right, and so we got 3 dumb bears and we got 1 smart bear. So who is the smart bear here?
It would be all the following to unlimited risk.
Yeah, remember to be protected, protection means insurance.
It would be that A.
Right on, right. That's how you protect that short stock position, putting in that floor, right?
Right.
The choice to buy back the borrowed stock at the strike price. We didn't get that today.
Mhm.
An investor is short the stock at 70. The stock market price is 40. The investor anticipates the price will continue to decline to hedge. Hedge means protection. Hedge keeps good things in, bad things out. And the investors should.
You would buy a call there.
There you go. Perfect. Perfect. I'm going to help you out here because we didn't get a chance to do debit spreads today. But we said there's 8 things you got to be able to do on a spread. Can you identify the spread? Can you determine debit or credit? Is this a debit or credit spread?
This would be so that we would be shorting the call, so it'd be
That's
a
right. It's a credit spread. We got more money in than out, right?
Yep.
So, debit means more money out than in, and we'd say exercise widen. That would be our loss, right? So we just go down that menu. So we want the contracts to expire. We want the difference to narrow. We're going to use Cal for our break even, call add to the lower. It is bad form, Zach, to tell me the answer is C or D, because you should know that the answer's got to be between 40 and 50.
Right. And it would be 46.
44. We're going to add the net premium.
Okay.
The net premium, right? So it's 44. Call add to the lower, right? It's the net premium, net premium. Boom. A customer buys 5 ABC, 50 calls at 5, and 5 EABC September 50 puts at 3. This position is called. It's testing identification.
So this is buying both a call and a put, so it'd be a straddle.
Excellent. It's a straddle. So we've identified it as a straddle. The next question is, can we calculate the break evens? So what is the upside break even? What is the downside break even?
So the upside would be 58 and the downside would be 42. Yeah, 42.
Excellent. Excellent. Third test question, where do you want ABC to be in relationship to these 2 prices?
You'd want them to be above or below.
Right on. You want it outside, right?
Not playing.
You want outside. Well, I think these are the hardest questions you get. The hardest problems, I think, are spreads where you're missing the premiums.
Right.
Remember the mantra? Lower, higher, longer. Lower, higher, longer. Lower strike call contracts always have greater premiums. Lower, higher, longer. Higher strike put contracts always have greater premiums.
Right.
Longer term option contracts always have greater premiums.
So this would be a credit bear spread.
A credit bull spread. Shorting a put is bullish.
Oh, yes.
Larger premium dominates. That's the toughest one I think you're ever going to encounter.
Hmm.
Right? So when we are doing this, this is the dominant leg.
Right.
Selling a put and a short put is a bullish transaction. So this is actually a credit bull spread.
Right. Okay.
That's the hardest one I think to get.
Mhm.
Right? Because people think debit means bullish, credit means bearish. Most of the time that's the truth, but not in this case.
Right. Right.
Boom, boom, boom. You purchase one ABC July 50 put and you sell one ABC October 50 put. The strategy is
Is that a calendar spread?
right on. Right on. I think those are the toughest ones. Remember the mantra? Lower, higher, longer.
Mhm.
Which one of those has a greater premium? The
It would be
July 50 put or the October 50 put?
the October.
Right on. Right. So there's going to be a credit spread because you're going to bring in more for the October than you're paying out for the July.
Mhm.
Excellent. By the way, if everything's different, everything's different. The strike, the months, everything's different. That's called the diagonal spread.
Okay.
I don't think you need to worry about it, but
Mhm.
the individual responsible for the overall supervision of Fidelity's options activities, boy, Zach, whoever this is, they need a couple more zeros on their paycheck.
Right.
This is the guy who's designated for incarceration. I'm joking, but so who is this person?
Be the registered options principal.
Right on. Right on. Which of the following orders would be used to eliminate or reduce or offset a short option position? This is very testable.
So it'd be a closing purchase.
Excellent. Excellent. Hey, listen, I think you did pretty damn good. I'm very impressed for as
Thank you.
far out as you are. And the performance in your tutoring session today was, I think, excellent. So I'm not worried about you. I think you want to keep doing what you're doing.
Absolutely.
Remember, it's not a transaction, it's a relationship. I always make this offer, I'll make it to you. I think you did so well in your tutoring session that if you'd like, you have the video, but if you return it to me and let me share it, I'll give you a free hour of tutoring. Just share it with other folks because you did a great job and I think it was a good session, particularly when we're not using slides. I like it when people say, yeah, let's do the board instead of
Right.
slide, I'm a big fan of that.